Jamil Baz is chief investment strategist at one of the world's biggest hedge funds, GLG Partners, with $23 billion of assets. Jamil is a former portfolio manager at PIMCO and teaches at Oxford. He's with us from London this morning. Jamil, great to have you. Let's start with something that plays off what we just heard there from Larry Fink. Your assessment of the EU sovereign debt crisis. What do you see right now?
Erik, I guess these days conversations about Europe are too polite to be honest. I think there are a couple of facts to keep in mind. Number one, Southern European countries will have to cut their fiscal deficits in the tune of 10% of GDP. This means that they stand to lose potentially about 15% of their GDP against trend over the next few years. And that's a lot of GDP to lose. Point number two, these countries have accessed EMU at artificially high exchange rates. Now, they need to regain about 20% competitiveness against Germany, which means that they'll have to live with a wage inflation of -3%, -4% over the next 5 years. They are paying about 5 to 6% nominal yield on their debt, which means that with an inflation of -3%, they stand to pay a real cost of debt of about 8 to 9%. And that's in an environment of negative inflation, negative growth rate, effectively a lack of power over their exchange rate policy or their interest rate policy.
Okay, so Jamil,
so it is doable.
If these politicians are being too polite to be honest with each other, what is that going to mean for the sovereign debt crisis? What is it going to mean for the euro?
I think that the euro will have to depreciate from here. It may not happen right now, but I think it belongs somewhere below the 120 level easily. I mean, they will have to get a boost from their exports, and absent that, I think, they will get a deflation, straightforward deflation for the next few years.
Okay, that's a pretty grim picture. Let's talk for a moment about how that relates to what we see here in the U.S. While concerns have been raised about the fiscal situation and the monetary union in Europe, similar concerns are being raised about the credit worthiness of the United States, whether it deserves that AAA rating. Do you expect that eventually, or perhaps even sooner than eventually, investors are going to take those concerns and start applying them to the Treasury market? Because you have to wonder how much longer Treasuries, the 10-year Treasury, can trade with a yield under 3%. What do you think?
Okay, I think the bad news are that, number one, the U.S. government is short a lot of options. It's short put options on its mortgage sector, on its banking sector, and on its consumers. Okay, effectively, if you look at something like Medicare and Social Security, these amount, according to some estimates, to maybe 500% of GDP in terms of the net present value of the deficits. However, the good news is that the United States has what's called the exorbitant privilege. In other words, it has a monopoly on world liquidity. And whenever there is a problem, including a problem in the U.S., investors will rush and buy U.S. securities. So my best guess is, it's going to look a little bit like St. Augustine's prayer, Lord, give me chastity and continence, but not yet. So it may take a little bit of time before investors come to the realization that it is unsustainable.
It's time to go back to our conversation with Jamil Baz, chief investment strategist at GLG Partners, a hedge fund with $23 billion in assets. Before the break, Jamil told us that he thinks the euro needs to trade under $1.20, and that eventually the same investors who have concerns about EU sovereign debt are going to visit those concerns upon the Treasury market. Jamil, as a chief investment strategist, it is your job to find relative value between asset classes around the globe. Tell me right now, what is underpriced? What's overpriced? Where do you get reasonable return for the risk that you're taking?
I guess the first order thing to say is that the U.S. equity is overpriced. When I calculate the risk premium of equity over inflation-linked bonds in the U.S., I find a number somewhere between 1.5% and 2%. And that's far too low. That average number in history was more like 4 to 5%. In other words, We are trading at less than half the average historical value, whereas that premium is supposed to pay for all kinds of risks these days, Eric. It pays for deflation risk, maybe down the line inflation risk, sovereign credit risk, geopolitical risk, protectionism risk, you name it. Unfortunately, the laundry list of risks is quite extensive these days.
All right, so if you're not getting your money's worth in U.S. equities, where do you think it's better? In other words, where are you getting that risk-reward premium satisfied elsewhere in markets around the world?
Right. If you look at credit, for example, on the same balance sheet, which is the S&P 500 balance sheet, credit is rated BBB minus, and it is trading somewhere at 250 above Treasuries. Whereas, as I just mentioned, equity is trading at 1.5% to 2% above Treasuries. So this is virtual arbitrage. What we're saying is that on the same balance sheet, equity, which is a junior item, is trading at yields below credit, which is a senior item. So U.S. credit is pricing a very bleak scenario, and I feel I'm getting paid to buy it.
Okay, and what else? So U.S. credit is a smart investment right now. There's so much more to choose from, though, between emerging markets. Europe, what do you like?
Europe is definitely cheaper than the U.S. If you look at the risk premium in Europe, and particularly in those southern European countries, the risk premium can be as high as 7-8%. So on paper, they're cheap, but obviously you've got to believe the forward earnings. In terms of what I like credit. I like even the risky part of credit, as in lower tier 2 and converts are even cheap to credit itself. And I quite like money market futures. In other words, you look at the euro-dollar futures strip, the short end of the interest rate futures, and they're pricing, say, 80 to 100 basis points of hikes between 11
Jamil,
and
I'm afraid we've run out of
2013.
time. Jamil Baz from GLG Partners.